Welcome to another episode of the brand called You, a podcast and podcast show that brings you leadership lessons, knowledge, experience, and wisdom from thousands of successful individuals from around the world. I'm your host, Ashutosh Garg, and today I'm delighted to welcome a senior professional with a deep understanding of finance and fintech and an author from Gurgaon, India, Mr. Maneesh Taneja. Manish, welcome to the show.
Thank you, Ashutosh ji. Thank you for having me on the podcast.
Thank you. Manish is an author of a book titled Seven Steps to Financial Freedom, Simple Habits, Compounded Returns. He's an independent financial advisor and he's a distinguished member of the Indraprastha Cancer Society. We're going to talk about his book today. So, Manish, my first question, what inspired you to write Seven Steps to Financial Freedom?
Right. So, Ashutosh ji, financial health is one of the things that drives our sense of self-being, sense of identity, gives us a lot of confidence. And India, as you're aware, we are overwhelmed with information, whether it's through social media or mainstream media, on how to invest, where should one invest, how can one generate a substantial return. And because there is so much information now, I thought, as somebody who's been a wealth manager for over 17 years now and is part of this ecosystem, I thought it's time that somebody from the ecosystem wrote a book which makes investing accessible and relatable. And this is my attempt at sort of cutting through the noise and giving some insights.
Very interesting. But tell me, why did you choose to focus on simple habits rather than complex investment strategies, which everyone else seems to be talking about?
Right. See, essentially, if we look at it, as human beings, we've been investing in managing risks for centuries. So when we really look at how we've been managing risk and investing over the years, it fundamentally comes down to a few thumb rules. And when you look at those thumb rules, you realize these are not very complex ideas or complex practices that you need to adapt to sort of manage money and manage your risk of investing money properly. These are simple habits. So they accumulated the lessons from the history of investing, and that one can eke out. You realize these are essentially simple habits, but what they really need is the discipline to inculcate and implement those simple habits. We as human beings have been successful in sort of simplifying the complex. Of course, it comes, we need to be disciplined about it.
Very interesting. Your first chapter, Manish, is titled Risk Hai to Ishq Hai. Why did you begin a financial book with a discussion on risk?
See, Ashutoshi, essentially, life is a risk management exercise. The fact anybody who's watching this and or hearing this podcast is an efficient risk manager. Life is all about trade-offs, right? The fact that somebody is giving us time to see this podcast or listen to this podcast instead of doing something else. Essentially, if they've taken a risk that this is worth their time. My idea was to sort of convey the point that you are anyways an efficient risk manager in your life. What you do in your life can be easily implemented when it comes to managing money, which is an integral part of your sense of well-being anyways. And anyways, in life, any endeavor, if you really want to achieve something in life, whether it's your financial goals or personal goals, you have to be a risk taker. And as individuals, we are risk managers and risk takers. So the idea was to sort of convey that point. You are anyways a risk manager. You know how to manage risk. You are an efficient risk manager. Why don't you try and implement some of those lessons in managing your money?
You also compare investment decisions with life decisions, such as a marriage and a career.
Right.
How are these similar?
Essentially, when we are let's look at our thought process when we are thinking of getting married or switching a job. What we are looking at is we've done a trade-off in our mind that if I decide to get married or if I decide to switch jobs, there is an upside that I look at, whether it is an emotional well-being, familial comfort, or more money, a better comfort, comfortable life. But it's still a decision with and where the returns are not guaranteed and you really don't know. There is a lot of uncertainty. There is a reason a lot of marriages end in a divorce. Not every career switch really works out, but you still do those things. So essentially what you've done is you've in your own mind figured out a risk management framework that this is the upside, this is what I need to do, and this is what can go wrong, which is not very different from investing, right? It is still a decision that has a lot of uncertainty attached to it. The upside's not really sure. You're not really sure of the upside. But there is a clear outcome that you can envisage that, yes, my portfolio will give a 12, 14, 13%, whatever return you're looking at. So the combination of decision making with an uncertainty, but you're backing yourself that you will have the desired outcome is
Mm.
the same, whether you're getting married or switching jobs or investing.
Okay. You describe diversification as the free lunch of risk management.
Right.
Tell me about this and why do you believe this is so powerful?
So diversification is something that we intuitively know and we all practice. I mean, the simplest example is I remember as a kid when we would be traveling to college by train, my mom told me, don't keep all your money in one pocket or
Mm.
in one place, right? Essentially, what you're doing is you are preventing or setting up a process which prevents catastrophic losses. The reason diversification is such a powerful tool is because it prevents catastrophic losses. Imagine for a moment that all our retiral funds were invested in Enron or let's say Satyam Computers. The fact that our money was invested, our retiral corpuses are invested across asset classes, across multiple equities or multiple shares, prevents catastrophic losses. So the power of diversification really is that it prevents life-changing losses. I'll give you a very simple example. Now there is an act where really diversification is not possible. That's when we travel. You can only carry passport as your travel document. Now, anybody who's had the bitter experience of losing a passport in a foreign country realizes what a painful task it is. But you can't diversify that risk, right? You have to carry your passport.
Mm.
So the power of diversification really is that it prevents catastrophic losses and something that can be very life changing or really makes it difficult to carry an endeavor forward. Diversification prevents that.
Mm. Well
That's
said.
why it's such a powerful line.
Very well
Powerful.
said. Very well said. Tell me, why do many investors understand diversification in theory but fail to practice it?
See, what we have to realize is everybody's got their lived experience. It's not that people are not taking risks. The fact that you're putting a fixed deposit with a bank or you're buying a real estate or you're buying a plot of land, you are essentially taking a risk. Now you understand risk, but what you also want to do is you want to be in familiar territory. You don't want to sort of try something new because there is anyway risk involved. So there is a lot of comfort in what you've been doing for a period of time. Also, we have to bear in mind, Ashutoshi, diversification also optimizes returns. If I can invest only in one stock and that stock goes 100x, or I can invest only in a plot of land that grows 100x vis-a-vis splitting my money across 10 stocks,
Mm.
I'm also optimizing my returns. So diversifications, it comes with its own, that aspect of diversification we need to keep in mind. So I think one of the reasons, the main reason people don't really diversify is because there's a lot of comfort in what they've been doing over a period of time.
Right.
It's a risk management framework that's worked for them, but obviously, and it's obviously worked for them because it's not optimized their returns.
Mm.
But it's my learning in life that one should always prepare. Diversification is a good tool to manage catastrophic losses, which
Mm.
is why people should be open to the idea of diversifying.
Interesting. What is the biggest misconception people have about risk in investing?
I think the biggest misconception people have risk in investing is they tend to extrapolate what's happened in the last 12, 18 months.
Mm.
Uh, so if let's take it in the context of stock market. So let's say the stock market's done really well over the last 12, 18 months. We tend to forget that stock markets do not give linear returns. We tend to extrapolate that what's happened in the last 12, 18 months will continue to happen over the next 12, 18 months.
Mm.
Similarly, if nothing's happened in the stock market in the last 12, 18 months, we convince ourselves, no, this is not my asset class, this is not where I should be. So our sort of the thing that we tend to extrapolate what's happened in the last 12, 18 months. If it's a good news, we continue to assume and continue to work on the assumption that the good news will not end. And if it's not been good news, we sort of extrapolate and tell ourselves that this is it, this is not working for me. So I
Mm.
think if we are able to step back and look at a larger time frame or look at a larger data set, we'll be able to avoid that pitfall.
Mm. You call compounding God's gift to investing. What makes compounding so extraordinary?
It's nature, it's universe gift. Nature rewards every incremental effort. Uh, we learn this in our school when we are taught the formula for compounding. But if you look around, evolution's nothing but evolution's nothing really but nature rewarding every incremental effort, right? Every incremental effort adds up.
Yeah.
And that's what compounding is. Ashutoshi, I know you play flute very well. I've been trying to learn guitar. And we know if we don't practice for a week, we can feel the difference. And if we don't practice for a month, our audience can feel the difference.
Mm.
And which is where I think the other aspect of compounding is often ignored. It's the discipline. If the benefits of compounding really have to accrue to us, whether it's in our personal lives or in our portfolios, we really need to put in that incremental effort every day, every week, every month. You can stay invested in a portfolio for 5, 7, 10 years, but if you're not able to continue for 15 years, which is when, let's say, your original investment goal was, then you will miss out on that benefit of compounding.
Mm.
So compounding is how nature works. It evolves incremental effort, but the real benefit of compounding comes only if we are disciplined. If we are not disciplined, then then there's a good chance you'll miss out on the benefits of
Mm.
compounding.
Mm. Can you give me some interesting real life examples that can explain the magic of compounding?
My PPF account, I opened it 20 years ago. Every year, Government of India gives us a return on it,
Mm.
and it's what we call in portfolio management. The Excel sheet has translated to a real experience. So now, when I see the balance in my PPF account, so that's a very simple example. I hope a lot of people will identify. The other thing that I've really benefited in compounding is my reading habit. I can read a lot more. I can read dense subjects and I can read a lot more than I could do 10 years ago simply because I've been at it. So I think any aspect of life that if the listeners and viewers were to
Mm.
look at their own lives and see anything that they've been doing for 10, 15 years, if
Mm.
you've been running for 10, 15 years, or if you've been learning a musical instrument for 10, 15 years, or if you invested in a plot of land 20 years ago in Gurgaon, essentially what's happened is you've benefited from
Mm.
power of compounding because you've stuck to it. I come back to
Correct.
the same point. You've stuck to it. You've not sold that plot of land. You've been practicing for the last 20 years. You've been reading for the last 20 years. You've been running for the last 20 years. So yeah, I've been lucky that
Yeah. Very interesting. Very interesting. In your chapter, Prepare for a Rainy Day, why do you emphasize emergency funds so strongly?
right. So this is an interesting. So the framework that I've really used here is we must be in life prepared for what I call low probability, high impact eventualities.
Mm.
It's a saying, right? 9,999 aeroplanes land and it's not news. One aeroplane crashes and it's news, right?
Mm.
Which is why anything that has a very low probability of happening but
Mm.
will have a disproportionate impact on your life, whether it's your personal life, whether it's on your finances, you must always prepare for it.
Mm.
Let's go back to December 2029, Ashutoshji. If I told you, sir, in 3 months the whole world will be, all be under a lockdown, we'll not be going out anywhere, and nothing like this would have ever happened, we would have both laughed at it. कि ये किस तरह का scenario building कर रहे हैं. But it happened, right? So what we really need to be sure is we need to really prepare for ourselves for low probability, but events that can have a disproportionate impact on life, and which is where a fund, which is just lying in your bank account. I know it's not earning you return. I know it's not beating inflation, but it's like insurance. It's there. And the fact that that fund is there, trust me, gives you a lot of confidence.
Mm.
It sort of builds your risk appetite for doing a lot of things, even if you're not looking at it from a point of view of preparing for a low probability, high impact event. Uh, but yeah, my framework that I've benefited in my life is clearly that one must always be prepared for a low probability and high impact events that can have a disproportionate impact on your life, which is
Mm.
where a rainy day fund always helps.
Very interesting. And how has your view of financial preparedness changed after witnessing events such as COVID?
Oh no, so this framework really got reinforced. Luckily, I mean, it's a very traditional thing in our Indian families to prepare kids from day one that, don't spend everything you have in your account. So it really got reinforced. I I mean, we know what happened during lockdown. A lot of people lost their jobs. The stock market tanked. So anybody who did not have at least 6 months expense in their bank account, what I mean by 6 months expenses, whatever cash flow you need every month to meet your monthly expenses, if you don't have 6 months worth of liquidity in your bank account, there was a lot of stress in families. So yeah, as luck would have it, I know it's 6 years, but the whole idea of low probability, high impact events is to prepare for those days.
Hmm. And tell me, what financial shocks are families most unprepared for?
Income disruption,
Hmm.
whether it's because of the earning member unfortunately passing away or a serious health expense. It's the fact that there is a regular income and that regular income defines your monthly expense, decides your monthly expense, and defines your lifestyle. If there is an interruption in a regular monthly income,
Hmm.
that has the biggest impact on people's finances.
Hmm. Very interesting. Before we move any further, I wanted to ask you, given everything that you've told me so far about the need for managing risk and the need for, making sure that you're investing well and keeping an emergency fund, how should an investor think about allocating money among equity, debt, gold, cash, and maybe land?
Right. So first of all, I would again emphasize that 6 months worth of your expenses. So whatever money you'll need to sustain 6 months of your current lifestyle, if there is an income interruption tomorrow,
Hmm.
that you should always keep in a bank account or what we call a liquid mutual fund, which is very safe and the liquidity is always there. So that should always be there. After that, it's a function of what stage of life you are in. If you're in a stage where you think large expenses, children's education or buying a house are still in future and you would like the portfolio to sort of grow at a higher rate, then you should grow for growth asset classes like equity or real estate. But if you're in a stage where now you're looking at just a regular income from your portfolio to sustain your lifestyle and then at some point transferring it to the next generation, then you could look at a portfolio which is skewed towards fixed income, which is not really a growth asset class. It's a function of where the person is in their lifestyle. I would urge that listeners and viewers of this podcast spend some time and maybe seek a professional to discuss this. But largely, it's a combination of if you're looking at accumulating or building a corpus, then you should look at being overweight on growth asset classes like equity and real estate. And if you're at a stage where you need a regular income from your portfolio, then I would suggest you be overweight on fixed income instruments.
Hmm. Moving on, Manish, you dedicate an entire chapter to financial advisors, and you're one of them.
Right.
What distinguishes a good advisor from a not so good one?
I think there are two things that we need to keep in mind when we are looking at taking services of an advisor. It's the what we call cycle and scale. How many cycles? But what I mean by cycles is equity markets or debt markets going up and then down. How many cycles has the advisor seen? What that means is how much experience does the advisor bring to the table? And if the advisor has had the opportunity of managing multiple sorts of portfolios, growth oriented portfolios, conservative portfolios, large treasuries where the focus is primarily on keeping principal safe. So, cycles and scale. How many cycles has an advisor seen? Have they seen serious drawdowns in equity markets or credit crisis? And then what kind of scale have they managed? The other thing, and which I think is the more important thing, really, is the incentive structure of the advisor aligned with your incentive structure? Is the advisor, because he's a professional, you should treat them as a professional?
Mhm.
Are they the kind of income that they're making through your by managing your portfolio? Are they aligned with your portfolio goals? So oftentimes it so happens that these incentives are not aligned. The focus can be on doing a specific product or giving a specific solution, which may not be suitable for the investor.
Mhm.
Or at the other time, there is often this. There is an outlook that I've seen. There's an attitude that I've seen that no, financial advisors really do not bring much to the table. I can assure you, financial advisors do bring a lot to the table.
Sure.
You can say that I am one, so I would say that, but it's my lived experience. I'll
Absolutely.
tell you why we can. So there should be an alignment of interests that, and I think everybody should be feel confident, have a very clear conversation
Mhm.
that this is the mandate that the investor is giving you, and if you deliver on this mandate, this is the remuneration that you will make. Both
Mhm.
parties should feel confident of having that discussion. So an investor should look for an advisor who's seen cycles and scales and look at aligning the incentive structure with the
Mhm. Well said.
advisor.
Well said. Why is living within one's means perhaps the most difficult step towards financial freedom?
Okay, so this, as since you've read the book, this is not really finance, personal finance. This is more like a life lesson.
Yeah.
I think the bane of our modern societies is that there's just too much pressure, especially on youngsters, to answer two fundamental questions:
Hmm.
how much money do we make, and how do we look? There's this huge pressure, and the modern capitalist society, everything nudges you to answer these two questions.
Yeah.
So the definition of how good we are or how successful we are or whether we've arrived in life is your ability to consume and your ability uh, to make money to for that consumption. And
Hmm.
that I think is a little bit of a trap because
Hmm.
there's no end to that race.
Hmm.
I mean, there's this famous poster in a gym, right? There's always somebody who can lift more than you. So there
Mm.
will always be somebody making more than you.
Yeah.
So if the whole purpose of if you've sort of gotten into this trap, and I don't blame you, we are all part of that system. If you've gotten into this trap of the next car, of the next watch, or the next shirt, I mean, as long as we are seeking validation by spending, we are trying to prove something to the world that we have arrived in life because we are making money and we are spending. It's a never ending race and it'll never sort of वो कहते हैं ना सर पैसा तो कभी खत्म ही नहीं मतलब
Mm.
nothing, it'll never be enough.
Correct.
It'll
Correct.
never be enough.
Correct.
And so one has to sort of resist that temptation.
Mm.
One has to realize there is more to life than there's more you can define your own success parameters as whether you want to your ability to spend or your ability to do something that gives you more joy or other meaningful things. So I think the reason we struggle to live within our means is because the world is making us answer these two questions, and that's how they've defined our sense of purpose and existence. And if we can challenge that notion,
Mm.
that no, I will not define myself basis my ability to consume or just spend, then I think the path to financial freedom becomes a little easier. That's my lived
Yeah.
experience. People may
Fascinating.
differ. People may
Very
differ.
interesting. Very interesting. So I have time for two more questions for you. In an era of social media influencers and AI tools, why does professional finance advice still matter?
I think so. I'll answer this question in the Indian context first. I think one of the things we have in India is we've always had access to cheap labor. So essentially, what it's done is like my cousins, my friends who live abroad, they know how to assemble a sofa. They know how to they clean their own cars. They clean their own houses. So there is a lot of do it yourself as a habit when you live abroad. In India, we've not for whatever reasons we don't have that habit. So when it comes to of doing it ourselves, so when you really have something like money, which is a very high stakes aspect of your life, we don't feel confident, although we are always there is no dearth of information. There are 1,000 videos on YouTube, there are 5,000 blog posts one can read, but because we've never had that confidence, we are always seeking for somebody to guide us, especially when the stakes are high.
Mm.
So, which is where I think technology and AI will be there. It'll always help you make a more informed decision. But
Mm.
there'll always be somebody who will be needed to sort of take the emotion out. At the end of the day, investing and decision making in life, whether you're getting married or switching jobs, and there is a reason people have life coaches, people have mentors, people have fitness coaches, right? A financial advisor will always will be needed is needed to manage your emotions, at the same time cut through the clutter and give you insights.
Mm.
And although I think AI will continue to evolve, it'll help you it'll help you break the clutter and sort of hopefully get more insights and right information. But to execute a plan or to sort of action that information, I think we always need a steady hand, somebody who's seen cycles and scale.
Yeah, well said. And my last question for you, Manish. What does financial freedom personally mean to you? And how has your definition evolved over the years?
Well, I'm a very middle class Indian boy, so obviously I grew most of my life in the same trap. I defined my uh, ability, my the definition of success for me was my ability to buy the next car, move to a
Mm.
bigger house, go abroad, travel. But once one has reached a stage in life, I realized that that's a never-ending game. You should do things that really make you happy, and that's what financial freedom now means to me. I've reached a stage in life where I do the kind of work I want to do. This book is part of that. I always wanted to write a book, and hopefully, people will find it useful. So, financial freedom is to do things you want to do it with people you want to work with. I think Morgan Housel writes about that in his book, Psychology of Money. I sort of paraphrase, I don't have the exact phrase right now, to do what I want to do with the people I want to do.
Mhm.
That's real financial freedom, and God's are kind. I've sort of reached a stage where I'm happy that I get to live the life I live, and my financial my portfolio is a big part of that. But it works both ways. So
Very interesting.
I've looked at sort of asking myself: is the next trip, is the next shirt, is the next car worth taking out time from things that make me happy?
Very interesting. And on that note, Manish, I just want to say what a fascinating conversation this has been. I'm sure my viewers and listeners will definitely learn a lot of interesting points from what you've told us in our conversation today. I'm sure they will look forward to buying your book, 7 Steps to Financial Freedom. And if they want to reach out to you, I'm sure there will be a way to contact you.
Yes, there
Thank
is a
you.
LinkedIn profile. Thank you, sir. Thank you, Ashutosh ji. Thank you for having me on the
Thank
podcast. Just a final note: all royalties of the book go to Sakshi's Joy Foundation. Sakshi's Joy Foundation helps underprivileged kids access pediatric oncology treatment at Rajiv Gandhi Cancer Research Institute in Delhi.
Thank you. Thank you for listening to the Brand Called You videocast and podcast, a platform that brings you knowledge, experience, and wisdom of hundreds of successful individuals from around the world. Do visit our website www.tbcy.in to watch and listen to the stories of many more individuals. You can also follow us on YouTube, Facebook, Instagram, and Twitter. Just search for the Brand Called You.